Here's the simple and beginner guide what stock market is and how to invest in it. Basically, stock market is a marketplace where public traded companies list their shares for purchase by investors. When a company goes public, it issues shares of stock that represent ownership in the company. These shares can be bought and sold on the stock market. So here is the question: how to invest in the stock market. First step that you need to consider is determine your investing approach. Actually, there are different ways to invest in the stock market. First investment choice that you have is to invest in individual or common stocks. Most people that invest in is common stock. Common stock represents partial ownership in a company with shareholders, getting the right to receive a proportional share of the value of any remaining assets. Common stock gives shareholders theoretically unlimited upside potential. They also risk losing everything if the company fails without having any assets left. For example, Apple or Netflix, where you buy its share, basically you become a part owner of the company. In its profit, you gain the profit. In its loss, you lose the profit. So another question that arises: when to invest in the stock market? You can invest in individual stocks if and only if you have the time and desire to thoroughly research and evaluate stocks on an ongoing basis. If this is the case, it is completely possible for a smart and patient investor to beat the market over time. Individual stocks can offer investors the potential for higher rate of returns than other investment options, but they also carry some potential downsides to consider. The first downside is having higher risk. Individual stocks are generally considered to be riskier than other types of investments, such as mutual funds or index funds. This is because the success or failure of individual stock is dependent on the performance of a single company, which can be influenced by a wide range of factors such as economic conditions, industry trends, and company-specific issues. And downside number 2 is lack of diversification. Investing in individual stocks can also limit your diversification, which is an important risk management strategy. If you invest heavily in one or just a few stocks, your entire portfolio could be negatively impacted if those stocks perform poorly. And the next downside is time consuming. Managing an individual stock portfolio can be time consuming and requires a significant amount of research and analysis. This can be challenging for individual investors who may not have the time or expertise to devote to actively managing their portfolio. The next downside is potential for emotional decision making. Investing in individual stocks can also lead to emotional decision making, which can be influenced by factors such as fear, greed, and market trends. This can lead to impulsive decisions that may not be in your favor. Overall, investing in individual stocks can be a rewarding but risky strategy. It is important to carefully consider your risk tolerance, diversification goals, and time commitment before investing in individual stocks. And here it comes, the second investment choice that you have is investing in index funds. What is index fund? Index fund is a type of investment fund that is designed to track a particular stock market index, such as S&P 500, and instead of a professional manager picking individual stocks to invest in, an index fund will invest in all the companies that make up the chosen index. So this makes it a passive investment. Index funds are known for their low fees and simplicity, making a popular choice for many investors. While index funds have many benefits, there are some potential downsides to it. The very first downside that it has is lack of flexibility. Index funds are designed to track a particular index. they are limited to investing in the companies that make up that index. This means that you may miss out an opportunity to invest in other promising companies that are not included in the index. And the next downside that it has is no active management. While passive investing through an index fund can be a smart strategy for many investors, but it does not mean that you won't have a professional manager actively making investment. This could potentially lead to missed opportunities or suboptimal investment decisions. The question arises that how much will you invest in the stock market? So first let's talk about money you shouldn't invest in the stock market. The stock market is no place for money that you might need within the next 5 years. For example, the money that you need to use for emergency purposes, or you will need to make your child's next tuition payment, or next year's vacation fund, or money you are socking away for a down payment of something. Even if you will not be prepared to buy a home for several years. So that's why it is one of the downside. So, and here is another step to talk about asset allocation. So let's talk about what to do with your investable money. That is the money you won't likely need within the next 5 years or so. This is a concept known as asset allocation, and there are a few factors come into play here. Your age is a major consideration, and so are your particular risk tolerance and investment objectives. Let's start with your age first. The general idea is that as you get older, stocks gradually become a less desirable place to keep your money. If you are young, you have decades ahead of you to ride out ups and downs in the market, but this isn't the case. If you are retired and reliant on your investment income, here is a quick rule of thumb that can help you to establish a ballpark asset allocation. Okay, first, take your age and subtract it from 110. This is the approximate percentage of your investable money that should be in the stocks. This can include mutual funds, ETFs, or other stocks. The remainder should be in fixed income investment like bonds or high yield CDs. You can then adjust this ratio to up or down depending on your particular risk tolerance. For example, let's say you are 40 years of age. This will suggest that 70% of your investable money should be in stocks, with the other 30% fixed in income. If you're more of a risk taker or planning to work past a typical retirement age, you may want to shift this ratio in favor of stocks. On the other hand, if you don't like big fluctuations in your portfolio, you might want to modify and add in the other direction. Okay, so all this, now let's talk which brokerage you need to select. So there are some specialized type of account called brokerage account. These accounts are offered by companies such as TD Ameritrade, E-Trade, Charles Schwab, and many others. And opening a brokerage account is typically a quick and painless process that takes only minutes. You can easily fund your brokerage via EFT transfer, by mailing a check, by wiring money. Opening a brokerage account is generally easy, but you should consider a few things before choosing a particular broker. So here it comes the type of account. Determine the type of brokerage account you need for most people who are just trying to learn the stock market investing. This means choosing between a standard brokerage account and individual retirement account, which is IRA. Both account types will allow you to buy stocks, mutual funds, and ETFs. The main considerations here are why you're investing in stocks and how easily you want to be able to access your money. If you want easy access to your money, are just investing for a rainy day, or you want to invest more than annual IRA contribution limit, you probably want standard brokerage account. On the other hand, if your goal is to build up a retirement nest egg, an IRA is a great way to go. These accounts come in two main varieties: traditional and Roth IRAs, and there are some specialized types of IRAs for self-employed individuals and small businesses, including the SAP IRA and Simple IRA. IRAs are very tax advantaged places to buy stocks, but the downside is it can be difficult to withdraw your money until you get older. Thank you very much for watching. Have a good day.